You've probably heard that the secret to getting rich in the stock market is picking that one breakout company, right? The next big thing. But what if that's all a myth? In this explainer, we're going to look at a way simpler and honestly a much more reliable path to building wealth over the long haul. So let's start with this big question. The entire financial world seems obsessed with this idea of beating the market, finding some secret edge that nobody else has. But what if that whole game is kind of rigged against you? What if the real winning move is just to join the market instead of trying to outsmart it? And that brings us to what I like to call the market beating myth. It's this super attractive idea that if you're smart enough or maybe just lucky enough, you can consistently pick stocks that do better than the overall market average. It sounds great, doesn't it? Well, here's the thing. The actual data tells a totally different story. Year after year, study after study shows that the vast majority of professional money managers, the people who get paid big bucks to do this, actually fail to beat the market. They charge you these high fees for their expertise, but their results, they just don't measure up. You literally end up paying more to get less. Okay, so if trying to beat the market is a fool's errand for most people, what's the alternative? Well, the answer is something called an index fund. Let's break down exactly what that means. The strategy behind an index fund is just brilliantly simple. It doesn't try to be clever. It's a passive investment, which means it just buys and holds all the stocks in a major market index like the S&P 500. So instead of trying to pick the winners, it just owns the entire playing field. When the market as a whole goes up, so does your investment. Simple as that. And this chart, it lays it out perfectly. Look at the difference here. Index funds, their goal is just to match the market. Their fees are super low, their strategy is totally automatic, and the outcome, you get the market's returns. Now look at the other side. Actively managed funds try to beat the market. Their fees are high, their strategy is selective, and their typical outcome, they often underperform the very market they're trying to beat. It's a classic case of paying a premium for worse results. So we get what index funds are, but what's the magic sauce? What makes them so powerful when it comes to growing your money? Let's dive into the core principles that really drive their success. It really all boils down to these four things. You could almost call them superpowers. First, you've got diversification, which protects you. Then, low costs, which means more of your money stays in your pocket, working for you. Then there's the incredible power of compounding, where your money starts making money. And finally, you're tapping into the long-term growth of the entire economy. Let's just sit with this idea of diversification for a second, because it's so important. Think about it. If you own stock in just one company, and that company goes bust, you lose everything. But if you own a teeny tiny piece of thousands of companies, well, if one of them fails, it's just a small blip. You're not putting all your eggs in one basket. You basically own a piece of the entire farm. It's a brilliant way to reduce your risk. And let's talk costs, because this is huge. A big index fund might have an expense ratio of just 0.04%. You know what that is? That's $4 a year for every $10,000 you have invested. It's next to nothing. Meanwhile, an active fund might charge 1% or more. That might not sound like a lot, but over decades, that tiny difference can literally cost you tens, even hundreds of thousands of dollars in lost growth. Low costs are an absolute superpower for your portfolio. You've probably heard this saying before, and it's famous for a reason. It's the whole philosophy in a nutshell. Trying to guess the perfect time to buy or sell, it's a fool's errand. Nobody can do it consistently. The real wealth is built by just being in the market, staying invested for a long, long time, and letting the overall upward trend do the heavy lifting for you. All right, let's make this less abstract. I want to talk about a real-world example that perfectly shows this idea in action. It's a famous index fund from Vanguard called VTSAX, and it's all about this buy the haystack philosophy. So check this out. With one single investment in VTSAX, you instantly become a part owner in over 4,000 US companies. That's everything from giants like Apple and Microsoft all the way down to tiny, innovative startups you've never even heard of. You're not betting on one company to succeed, you're betting on the entire American economy. And this is the line that just makes it all click. It's from Vanguard's founder, the late, great John Bogle. Don't look for the needle in the haystack, just buy the haystack. Why would you spend all your time, energy, and money trying to find that one magic stock, that single needle, when you can just buy the whole haystack? You're guaranteed to get the needle, plus all the other hay.
It's such a simple but profound shift in thinking.
Okay, so this all sounds amazing, right? But how do you actually do it? How do you put this into practice? Well, let's get into our final section, your winning strategy. And the best part is, it's unbelievably simple. The key to the whole thing is a technique called dollar cost averaging. Now, I know that sounds like some complicated financial jargon, but I promise it's the easiest thing in the world. It just means you invest the same amount of money on a regular schedule, say every 2 weeks, no matter what the market is doing. Is the market up? You invest. Is the market down? You invest. It takes all the emotion and guesswork out of it.
So here it is, your 3-step plan. Number 1, invest regularly. Set it up so it happens automatically from your paycheck. Set it and forget it. Number 2, and this is probably the hardest part, ignore the noise. The news will scream, the market will crash, people will panic. You just stick to the plan. And number 3, let time work its magic. Be patient. This is not a get-rich-quick scheme. It's a get-rich-for-sure plan if you just give it enough time.
Which leaves us with this final thought. In a world that's always trying to sell you on complex, expensive solutions, what if the simplest path is actually the smartest one? What if the key to building real, long-term wealth is to just ignore all that noise, embrace simplicity, and buy the whole haystack? Well, all the evidence seems to suggest that for most of us, the answer is a resounding yes.